Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Steve Saretsky. He's a Vancouver-based realtor. You can find him online at stevesaretsky.com. Welcome back to the show, Steve, and happy holidays.
Likewise. Thanks for having me on. Always a pleasure.
Steve, where do Canada's debt slaves rate on a global basis?
Well, I think on a global basis, there's a lot of metrics to look at. I think that certainly in the G7, Canadian households are the most indebted in the G7, and in the G20, I believe they're in the top two rankings. So, obviously, households have taken on a lot of debt. So I think that's really just a decade and 2 decades really of, I think, looser credit standards than at least the rest of the world. And that's why we have households, balance sheets where they are today. And I think home prices are, a mirror image of that as well.
Mm-hmm. Now, they just did a study saying charitable contributions in Canada are at their lowest level in 20 years. Is that because people have such big debts to keep a handle on?
Yeah, it's hard to say. I think that might play certainly a part of it.
What's the latest on home prices and sales in Greater Vancouver?
So in November, we had basically home sales around sort of 10-year historical averages. Basically, the low end of the market is moving quite well. Quite quickly, we're seeing things sell fast, multiple offers, and then you sort of have this high-end luxury market, which I think is still quite soft, really just a result of I would say a lot of foreign inflows. Chinese capital flight is still quite weak, and that those buyers haven't really returned to the market, especially considering to the extent that they were in 2015, 2016. And so, that market remains sluggish.
Now, when we talk about low-end prices in Vancouver compared to the rest of the country, they're still quite high, aren't they?
Yeah, in Greater Vancouver, I think obviously Greater Vancouver's got the highest prices in Canada. I think Toronto's getting close to giving us a run for our money, so to speak. But I don't think that the affordability issues haven't gone away. We saw a dip in prices over 2018, and what we're starting to see is at the end of the day is that even if prices came down 15%, which I would say they did. At the end of the day, there's still an affordability problem. There's still a shortage of affordable homes here in Greater Vancouver. And given that interest rates are still at rock bottom lows and the, labor market is still relatively strong, that there's still a demand for housing, and there's just ultimately, too many people competing for too few product, that's within an affordable price range, for locals.
Now, of course, there isn't any regulation when it comes to, what kind of property people develop. Did developers look too much at the high end of the market and not enough at what we would call the working person's affordability level?
Yeah, I think that's just a result of sort of this last 10 years of sort of, easy money, I would say a lot of the wealth is accrued to the top end, and so I think developers were basically building towards that, catering to sort of the higher end luxury market. That's not really just a Vancouver story. That's really I would say a North American story. If you do any sort of research into the U.S. housing market, they're going through a similar phenomenon where basically everyone is sort of focused on a luxury product. And so, I think that's where you're starting to see a continued divergence in sort of a wealth inequality. And so, what we're seeing is developers have built for profits and built for profit margins, and that's, best obtained in the luxury market. Obviously now with the luxury market softening, I think that you're starting to see, more developers switch their business model, so to speak, or switch to purpose-built rental buildings. CMHC has been financing a lot of those with very generous financing terms, and so that's what we're starting to see is more of a local shift now.
Now, when we say low end, we're talking condos mostly?
Yeah, I would say basically, I mean, I look at it in Vancouver, as crazy it is to say, is I think anything under $1 million is kind of, what an affordable, or what people are basically trying to squeeze into. And so we know where incomes are. We know that people are obviously stretching even at those price levels. And, that's I mean, like I can tell you specifically in the city of Vancouver is like, if you got a, one bedroom condo under $650,000, that's going in multiple offers, any day of the week. So, that's, I guess, what people are deeming affordable. And, that's, again, I don't think we've really solved any of those affordability issues.
Mm-hmm. Now, do we have affordable units, in the works here being built, or have they run out of places to develop and they're just going to, bite the bullet to sell their higher end product?
I think that affordability, I think from a developer's perspective, is it's tough to even get that, just because really it just comes down to the cost of land. I mean, we are seeing the cost of land come off significantly over the last year and a half. That's just primarily because developers are looking at the numbers, looking at the pro formas and saying this just doesn't work. And so, yeah, you've seen the land values come off a lot, but even then, the cost of construction, the materials, labor, et cetera, those are still very, very expensive. And so it's tough to really build, I guess, a quote unquote affordable product.
How much, of a project, when you build it, goes to the local government? I know a project in Burnaby, the city, on the proposed price for the whole thing, they would get a third of the money, and the developer would, and the property owners get the other 2/3.
Yeah, I think it's going to vary project to project, but obviously I think that, in Vancouver, and really I think Canada-wide, there's just so much political interference. Everybody's got their hand in the cookie jar, so to speak, and so there's no question that, increases in taxes, regulations, building codes, everybody's trying to keep everybody happy, and, this sort of bureaucracy ultimately is reflected in the price, and it comes back down to that price eventually ultimately gets passed on to the end consumer. So there's no question, in my opinion, that I think government has been in the way of a lot of these housing problems, and the fact that to get a project from start to finish, say a high-rise concrete project, is going to take you 6 or 7 years in some cases. So the ability to get supply to the market is so bogged down through government regulations and costs that I think that we're kind of shooting ourselves in the foot ultimately.
We'll have more with Steve Saretsky right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Steve Saretsky. Steve, is the fourth quarter generally a strong time for real estate?
Well, typically it's a slower time of the year. Seasonally, you'll actually see, seasonally speaking, you should see, in a normal cycle, you'd see sort of prices ease off a little bit. Inventory would, historically would drop a little bit, because you don't really see sellers listing in the winter months. And buyer activity also drops off. So yeah, you generally see a slower housing market. But what we're seeing, I guess, this year is we're seeing definitely an increase in activity, at least in normal circumstances. So normally you would see, your spring market is your sort of hot, your most busiest season, and then the summer months start to slow down, fall picks up, and then winter slows down again. So what we've seen this year is the spring market was incredibly bad. The summer was really quite busy, and then basically the fall and the winter months have sort of continued that pattern. So, it's been strange. I think there's just so many odd divergences right now that we're seeing that kind of keeps you on your toes. This market continues to sort of turn heads.
Is the high end of the real estate market starting to pick up a bit?
To be honest, not really. I would say it doesn't feel like it's maybe coming down as much or as quickly, but I think there's a lot of things in the work. I mean, there's no question. There's foreclosures have been picking up, particularly for the high end homes, and those will continue to pick up. Just based on my conversations with a lot of lenders and looking at some of these scenarios, is that a lot of these foreclosures are being pushed further and further out. You're seeing basically lenders saying, "Oh, it's okay. You haven't sold. We'll give you another 6 months. Oh, 6 months is up. Okay, well, hey, we'll give you another 3 months." But, at the end of the day, the lenders are only willing to wait so long. And I think that, they've been patient, and we're certainly going to see them, start to cut ties. So we will see the foreclosure numbers start to rise.
If foreclosures start to rise, does it make it more difficult for people to get a mortgage?
If it comes systematic and problematic, I think the numbers right now are so small. It's right now we're rising off historically a very, I think one of the lowest bases of all time. So we're rising off this very low base. But if you look at it from a contextual perspective, the total number of foreclosures in Greater Vancouver is still very low.
Of course, people look at foreclosures as being bargains. Are they really?
Not really. I think that, the foreclosure process in BC is quite, forgiving for the owner, for the seller. So that basically, it's not like you go to the in the U.S., show up at court and you just, you get a property for 40% off. In BC, they want the property to be listed on the MLS for a certain amount of time, marketed, and then they have to basically prove to the judge, they have to prove in court that they did their best to get quote unquote market value. So, foreclosures won't just jump on the first low ball that comes in.
We'll have more with Steve Saretsky right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Steve Saretsky. Steve, with a federal minority government, is there pressure to remove or reduce the stress test?
I wouldn't say there's pressure, but obviously we're reading more and more articles and headlines coming out that the finance minister has been asked by Trudeau to review and revise stress test, whatever that means. I suspect that it could have something to do with the renewal process. It could have something to do with maybe tweaking the how severe the mortgage stress test is in terms of the qualifying rate. Again, I wouldn't put it past, the federal government, to look and potentially try to intervene, against OSFI's, willpower, I guess, so to speak, to try to, correct and amend the stress test and make it easier. I think that we all know that housing plays a predominant role in the Canadian economy, and I think that the government is inclined to try to keep that going and keep that as a propeller of growth. Despite what ultimately I think many people would agree there should probably be a correction in home prices to get back to some semblance of affordability, but I don't think that governments are overly interested in doing that.
If we had long-term mortgages like they used to do, I think back in the 70s, where you could get a 25-year mortgage straight out, that was the term. So if you qualified for that, you knew you didn't have to renew every 2 or 3 or 5 years. Would it be better for home buyers if they allowed those kind of mortgages or encouraged long-term mortgages again?
Yeah, I think it definitely mitigates the renewal risk. I think that's probably one of the largest factors, right? I mean, if you're taking on $1 million mortgage, which is, realistically not that uncommon in Vancouver, you're taking on $1 million mortgage at 3%. I mean, you're in a whole heap of trouble if that thing climbs up to 5% when you go to renew. So, so obviously I think a lot of the longer term, term duration for mortgages, I think has more to do with, the bond market here in Canada. I don't know why, I can't really give you a clear answer in terms of why we don't have the longer duration, but, I'm still in the belief that I don't think that the mortgage stress test was brought into place, necessarily to curb the risk of, renewal risk. I think it's ultimately designed to slow, household indebtedness. It's designed to curb the growth in home prices. I think that's where, in my opinion, policymakers are looking at it from. I don't think that they're as overly concerned, in my opinion anyways, that, of the renewal risk or that rates could jump to 5%.
Is the stress test designed to protect home buyers or the banks?
Yeah, I guess just sort of adding to that, I think it's ultimately designed to protect the banks, to protect the financial system. So I think that, a lot of the general public or the real estate and mortgage industry, I think they get it a little bit confused. I think that people look at it and say, well, Canadians don't need regulating. They can decide how much they should borrow and how much they want to borrow, and we don't need somebody telling us, that there should be an arbitrary stress test. But again, I don't look at it that way. I look at it that this is brought in to mitigate the risk of the financial system. The Bank of Canada has been very clear that household debt is the most concerning and it is the most vulnerable shock to the financial system should anything arise. And if you do any sort of research on any sort of financial crises are always stemmed almost all the time to the private household sector. So that's, in my opinion, why the stress test was brought in. It's designed to reduce and mitigate potential and future risks in the financial system.
Is the CMHC taking on more or less risk?
Today, CMHC has mitigated a lot of the risk. You look at insured mortgage growth through CMHC, it's dropped off significantly by more than double digits over the last few years. So CMHC is trying to get away from this program, which over the last previous decade, basically they were brought in to essentially pump out a lot of loans, insure them, get them off the bank's books, balance sheet, so to speak. And I think that they played a huge role in ultimately driving home prices higher. And I know that since the introduction of Evan Siddall taking over CMHC, there's been a complete shift to basically stop supporting the housing market, start supporting higher prices, and ultimately try to deviate some of their funding towards the rental market. So they're trying to sort of, we have a 69% home ownership rate. House prices are so high. The reality is not everybody can or should be owning, particularly at these prices. Let's start encouraging developers to build purpose-built rentals. Let's provide Canadians an alternative to home ownership. And so that's what we're seeing is CMHC is getting away from, massive insurance of, over-leveraged buyers to basically, incentivizing and helping fund, new rental developments.
Are the banks likely to take on more risk themselves by providing mortgages in a declining market?
For the banks to decline mortgages in a declining market?
Well, are they just willing to take on more risk themselves?
Well, I mean, obviously, I think banks function the same as just really like any investor. If you want to make it, dumb it down to some simplistic sake, I think that if home prices are declining across the board, banks aren't going to start increasing their lending unless the government sort of steps in and provides some sort of assurance that they're going to be there to backstop them. So basically, yeah, the banks, if home prices start to slow, that's why you can clearly see it's a lot more difficult today to get a loan in, say, Alberta than it is to get a loan in Ontario, for example. So it really comes down to the banks. They like to mitigate their risks, and so if they don't see an overly bright or optimistic economy or housing market, then they won't lend into it.
Is that a good indication of what we could see happen with the economy in general? Is recession around the corner if people aren't buying homes?
Well, I mean, I think that the recession card's been out there. I think that the cycle, we're now the longest expansion, in recent history. So, I think it's hard to pinpoint when a recession comes. It could be this year, it could be next year, it could be 2 or 3 years away. But obviously, I think that we are getting closer to that. And I think that, what we're seeing anyways in the recent data, we'll have to see maybe that shifts around, but we are seeing obviously is rising consumer insolvencies. They're growing at their fastest annual pace since I believe the 1970s. Since 2009, I believe, but year to date, consumer insolvencies are the highest since I think the 1970s. And you had a recent contraction in the labor force, and today you saw retail sales contract as well. So, rising insolvencies, slowing retail sales, and contracting labor force are generally not an environment that you expect home prices to rise in. But as it looks right now, if you look at the National Home Price Index, it's rising. So, kind of, I guess, maybe comes into question of how sustainable that rise is. It really ultimately depends, I think, on that economic backdrop.
Do interest rates in the bond market continue to be a concern?
I'm personally not in that concerned camp. We've seen yields in the 5-year Canada bonds start to rise again, so that's pushed mortgage borrowing costs back up to close to around 3%. But again, you're still able to borrow a mortgage for 5 years at basically 3%. So, still very, very supportive of housing market, housing prices. Still well below the recent peak. I think rates shot up to about 3.6% at the end of 2018. So, we've seen a little bit of activity in the bond market. But yeah, I would say overall in general, I don't think there's a concern of rising mortgage costs at this point.
Steve, have a great holiday.
Thanks a lot, Jim. You too.
My guest has been Steve Saretsky. He's a Vancouver-based realtor. You can find online at stevesaretsky.com. If you have any questions for Steve or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.